start by understanding what a partnership means under Malaysian law. According to the Partnership Act 1961, a partnership is simply a relationship between people who run a business together with the goal of making a profit. For tax purposes, partnerships are governed by the Income Tax Act 1967. It's important to note that a partnership isn't a separate taxable entity. Instead, the partnership's income is calculated as a whole, and then the profits or losses are divided among the partners based on their agreed profit-sharing ratio. Each partner is then taxed individually on their share of the profits. Malaysia, partnerships are considered transparent for tax purposes. This means the partnership itself doesn't pay tax as a business entity. Instead, after the partnership's income is computed, each partner is taxed on their portion of the profits. This approach ensures that tax is only paid once at the individual partner level, rather than at both the partnership and partner levels. This transparency is a key feature that distinguishes partnerships from companies, where the company itself is taxed separately from its shareholders. Partnerships in Malaysia can include several types of partners, each with different roles, responsibilities, and tax implications. The main types are active general partners, sleeping dormant partners, limited partners, nominal partners, and minor partners. The type of partner you are determines your involvement in the business, your liability for debts, and how you're taxed on your share of the profits. Let's explore each type in detail to see how they differ and what that means for your tax obligations. Active partner, also known as a general partner, is directly involved in the day-to-day operations and management of the partnership. They contribute capital, skills, and effort, and have the right to participate in decision-making. Importantly, active partners are jointly and severally liable for the debts and obligations of the firm. For tax purposes, their salary, interest on capital, and share of profit are not deductible to the partnership. Instead, these amounts are taxed as business income in the partner's individual tax return. Losses are also shared according to the partnership agreement. Sleeping or dormant partner contributes capital to the partnership but does not take part in management or daily operations. They are sometimes called silent partners. Despite their lack of involvement, their liability remains unlimited in a conventional partnership. They are entitled only to share of profits, as agreed in the partnership agreement, and do not receive a salary or interest on drawings. For tax purposes, sleeping partners are taxed on their share of profit, and if the partnership incurs a loss, their share of the loss can be carried forward to offset future business income. Limited partners are found in limited partnerships and limited liability partnerships, LLPs. They contribute capital but have limited liability, meaning they are only liable up to the amount they invested. Limited partners cannot take part in management. If they do, they lose their limited liability protection. In an LLP, the entity itself is taxed as a separate legal entity, much like a company, and partners are not taxed again on profit distributions received from the LLP. This structure offers protection and is popular among professional firms and SMEs. Nominal partner allows their name to be used by the partnership, but does not contribute capital or participate in management. They may act as a representative to lend prestige or credibility to the firm. While nominal partners are not entitled to profits, they can be held liable to third parties if their name is used in business dealings. For tax purposes, since they do not receive profits, there is generally no tax liability. However, if they receive any income or fee for the use of their name, it is taxable under Section 4(f) as other income. Minor partner is someone under 18 years old who is admitted to the benefits of a partnership with the consent of all partners. Under Malaysian law, minors cannot be full partners and cannot be held liable for the partnership's debts. They are entitled only to share of profits and are not liable for losses. For tax purposes, the minor's share of profit is taxable in the name of the minor, unless parental aggregation applies if they are under the same household. The partnership itself cannot claim any deduction related to the minor's profit share. Tax treatment for each type of partner depends on their involvement and liability. Active partners are taxed on salary, interest, and profit share as business income. Sleeping partners are taxed only on their share of profit. Limited partners and LLPs are not taxed on distributions, as the LLP itself pays the tax. Nominal partners are taxed only if they receive a fee or commission. Minor partners' profits are taxed in their own name or in some cases in their parents' return. Understanding these differences is crucial for proper tax compliance. There are several key points to remember about partnerships under Malaysian tax law. First, a partnership is not a separate taxable entity. Income is divided among partners. Second, partners' salaries, interest on capital, and drawings are not deductible to the partnership. Third, each partner is taxed individually on their share of income. In an LLP, the entity is taxed, not the partners. The profit-sharing ratio in the partnership agreement determines each partner's tax exposure. If a partner joins or leaves mid-year, income is apportioned accordingly. Partnerships in Malaysia can be classified into three main types: conventional partnerships, limited liability partnerships (LLPs), and professional partnerships. Each type has its own legal structure, liability rules, and tax treatment. Understanding these distinctions helps business owners choose the right structure for their needs and ensures compliance with tax regulations. Conventional partnership is governed by the Partnership Act 1961. It is formed by 2 to 20 persons, except for professional firms which may have more. The partnership is not a separate legal entity, and all partners share profits and losses based on the agreed ratio. Partners are jointly and severally liable for the debts and obligations of the partnership. For tax purposes, the partnership's total income is computed first, then each partner's share is assessed in their individual tax return. Salaries and interest on capital are treated as appropriations, not deductible expenses. LLP is a hybrid structure that combines features of a company and a partnership. It is a separate legal entity and can own assets, sue, or be sued in its own name. The liability of each partner is limited to their capital contribution, and there is no limit on the number of partners. LLPs are popular among professional firms and SMEs for their flexibility and protection. For tax purposes, an LLP is treated like a company and taxed at a flat rate of 24% on its chargeable income. Partners are not taxed on profit distributions from the LLP. Professional partnerships are typically formed by licensed professionals, such as lawyers, accountants, architects, and engineers. These partnerships must comply with the regulations and ethics of their governing bodies, like the Malaysian Institute of Accountants or the Bar Council. Partners are personally liable for professional misconduct but share profits and losses like a conventional partnership. For tax purposes, professional partnerships are treated the same as conventional partnerships, with net business income calculated at the partnership level and distributed to partners for individual tax reporting. Let's summarize the main types of partnerships in Malaysia. Conventional partnerships are not separate legal entities and have unlimited liability. LLPs are separate legal entities with liability limited to capital contributions and are taxed as companies. Professional partnerships are not separate legal entities and are treated like conventional partnerships for tax purposes. Each type has its own tax return form, Form P for conventional and professional partnerships and Form PT for LLPs. Conventional and professional partnerships, tax computation starts with calculating adjusted income, which is business income minus allowable expenses. Next, non-business income like rental or interest is added. Capital allowances are deducted to arrive at divisible income. This income is then divided among partners according to the profit-sharing ratio. Each partner includes their share in their individual tax return, using Form B or B. This process ensures that each partner is taxed only on their share of the partnership's income. LLPs, the entity itself computes and pays tax on its chargeable income. The LLP files its own tax return using Form PT and pays tax at a flat rate of 24%. Partners do not pay tax again on distributions received from LLP profits. This structure simplifies tax compliance for partners and provides liability protection, making LLPs an attractive option for many businesses. There are several important differences between conventional partnerships and LLPs. Conventional partnerships are not separate legal entities and have unlimited liability with 220 partners. They are tax transparent, meaning partners are taxed individually. LLPs, on the other hand, are separate legal entities with liability limited to capital contributions and no limit on the number of partners. LLPs are taxed as companies at a flat rate of 24% and partners are not taxed on distributions. The tax return forms also differ, Form P for conventional partnerships and Form PT for LLPs. Using the right partnership structure depends on your business needs, risk tolerance, and tax preferences. Conventional partnerships offer simplicity but come with unlimited liability. LLPs provide liability protection and are taxed like companies, making them suitable for businesses seeking flexibility and risk management. Professional partnerships are ideal for licensed professionals who must comply with regulatory requirements. Understanding the differences helps you make informed decisions and ensures compliance with Malaysian tax law. Sum up: partnerships under Malaysian tax law can take different legal forms, each with distinct tax implications. Conventional and professional partnerships are tax transparent, while LLPs are taxed as separate entities. Partners' roles, liability, and tax treatment vary depending on the partnership type. Understanding these distinctions is essential for choosing the right business structure and ensuring proper tax compliance with the Inland Revenue Board. Though you're starting a new business or restructuring an existing one, it's crucial to understand the types of partners and partnerships under Malaysian tax law. Each structure offers different benefits and obligations, especially regarding liability and taxation. By carefully considering your options and seeking professional advice, you can select the partnership type that best suits your business goals and ensures compliance with all relevant tax regulations.